One of the many things that makes crypto assets so fascinating is the level of uncertainty and the number of unanswered questions around them. People have put forward all sorts of ideas and predictions about how things might pan out, and some of those ideas are actually quite compelling, but in almost all cases they will conflict with the equally compelling thoughts of others, and ultimately nobody knows how any of this is actually going to play out. All we can do is watch and wait. In the coming decades, we're slowly going to discover the answers to these big crypto questions, and we're finally going to be able to see how everybody's predictions map onto reality. So here are some of the biggest questions that I hope we see answered in the 2020s. It seems likely that the 2020s will be another decade of experimentation, of building, failing and learning for most crypto assets, with many projects still in an embryonic phase and a huge number of important design questions still to be answered. One of those design questions, arguably the biggest one, is will proof of stake work? Or at least under which conditions is proof of stake most viable? That may seem like a silly question, as there are already a number of proof of stake systems operating in the wild, but it's really too early to tell if any of these are or will actually be successful, given they've not been running for too long, and none of them have yet provided a particularly large incentive to break them. However, just as the first decade of crypto assets told us when and where proof of work can be successful, the next 10 years will hopefully inform us of which flavours of proof of stake are workable and under which conditions they work best. We're going to find out if the economic incentives of staking can be undermined by the potentially large rewards available through lending platforms or DeFi products. We're going to see if slashing is an absolute requirement of proof of stake, or if new interpretations without it, such as Cardano's Ouroboros, can be successful. And we're probably going to see how quickly things unravel when somebody creates a weird new token that represents the coins you've got locked up to stake. It's certainly going to be a fascinating period of experimentation across a range of projects, and I really do hope we see a lot of successful implementations emerge. But before we can be comfortable with any of them, we need to see networks of substantial value operate flawlessly for multiple years. So if Ethereum or something else of similar size can get proof of stake up and running in the next couple of years, and then manages to get through the entire decade without any troubles, we can really start to feel confident that there might be another way forwards instead of proof of work. Something that could really test the reliability of a network's proof of stake system is a focused and well-funded attack by a competitor. Right now, that might seem like an unrealistic scenario, but with billions of dollars potentially up for grabs in a winner-takes-most game, the gloves may well come off over the next few years. People have talked about protocol wars or blockchain wars for years now, but in most cases I really think they mean to say competition instead of war. Generally, when talking about this, people are thinking about the race to deploy first and to attract developers, to begin building crucial network effects. And sure, that will be an interesting thing to watch, but it won't be much more dramatic than any other business or sporting competition. It's entirely possible, however, that the tension will boil over and evolve into something much more brutal and intense, something that will make the word war much more appropriate. With a handful of ICO-era projects still hanging on, and a new wave of VC-backed chains in their early stages, the next few years may well be the zenith of relatively well-funded but ultimately undifferentiated smart contract platforms. And with many of these attempts likely to die off, various members from each of their communities could try and undermine the progress and the development of competitors to protect their own interests. So just as you can use services like NiceHash to rent computing power to attack proof-of-work networks, coin lending services could be weaponized to launch proof-of-stake attacks against vulnerable projects. Alternatively, attackers could look to corrupt on-chain voting either by borrowing the coins necessary to swing a vote, potentially using the effectively free flash loans that we used to attack BZX recently, or more interestingly, they could use bribes and even prediction markets to try and create perverse incentives for voters. These are just a couple of fairly obvious scenarios that could play out, and I'm sure others will come up with much more inventive methods of attack. To a large extent, I hope this doesn't happen. I think the overall industry would be much better off if everybody worked more collaboratively. But if the blockchain wars do take place, at least we will know that the surviving projects are truly robust enough to withstand anything that can be thrown at them. However the battle between competing projects plays out, it seems likely that there's going to be a financial element to it. The question though is, how exactly will money actually impact and affect things? The obvious answer is that the most well-funded attempts will have a better chance of success. Not only will they have a longer runway than the less well-funded projects, but they can afford to hire more high-quality developers, they can throw more money at marketing, and they can offer greater incentives to kickstart a community and benefit from the compounding network effects that come with that. The thing is though, none of that has actually played out in reality, at least not yet. And while there's a bunch of possible reasons for wealth not being a differentiator so far, it's entirely possible that it just isn't and won't ever be a differentiator for crypto assets. Primarily, that's because the thing that seems to matter most is the development of large, organic and genuinely passionate groups of users and developers, an army of zealots that stick to a project through thick and thin, who evangelize, who use, who build things faster, better and more creatively than any size group of hired muscle ever could. Most attempts to buy that kind of community and dedication, using airdrops for example, have failed, suggesting that the reserves held by central teams mean relatively little. However, there are ways that war chests could make a big difference in the years to come. With a boatload of cash in hand, struggling war chest projects could set out to buy and integrate less well-off but slightly buzzier efforts, using the remaining funds to support the existing community rather than squander it trying to build their own. These buyouts and mergers could happen in a few different ways, from fairly traditional and boring cash offers made to the core teams, to much more interesting approaches like buying up a large portion of the circulating supply of tokens and trying to become a kind of activist investor that drives the entire community towards a merger. I'm intrigued to see both if and how these kinds of things are carried out, and also how they'll be perceived by the wider crypto community. I think the obvious projects to watch for this kind of activity are Tron, who have already shown their willingness to get their checkbooks out whenever an interesting opportunity arises, and also EOS, given they have billions of dollars on hand and seem to be floundering at the moment. Perhaps for them, a well thought out acquisition could help them to turn things around. Most of the war chest projects accumulated their wealth using initial coin offerings, which later mutated into the similar but arguably worse initial exchange offerings. While both of these approaches became grotesque and exploitative pretty quickly, and thankfully they're both almost dead today, there were some good things about them, things that could have a lasting impact on investing and fundraising in the years to come. The popularity of ICOs could be taken as a sign of the general public's desire to be involved in risky but potentially lucrative early stage investing, the sort of thing they currently can't access because of accredited investor rules, indicating that these laws are outdated and in need of change. This certainly seems to be the conclusion the SEC has come to, with the agency proposing amendments to these rules last year. It'll be interesting to see what other changes are made in this area in the coming decades. The more interesting question, to me at least, is how will crypto projects move forwards? ICOs allowed all sorts of things to raise money, including downright foolish ideas and scams, but they also enabled a number of legitimate projects. In fact, some of the most important and exciting projects in development today wouldn't be around, or at least wouldn't be as far along, without a token sale to raise money. But there's got to be better, less risky, less exploitative ways to support the development of both base layer protocols and the applications built on top of them. And ideally, these funding methods should eliminate the need for proprietary tokens that have to be jammed into whatever is being built, and they should even allow important applications to sustain themselves while capturing little to no value. One approach that saw significant growth in 2019 was Gitcoin, an Ethereum-based platform built to incentivize and support open source development. While they've created a suite of projects that includes bounty programs, hackathons, and non-fungible tokens, they're best known for their grants program, which uses a concept called quadratic funding to allocate money from a $200,000 pool to a range of projects. These grants have already seen $1.2 million distributed across all sorts of Ethereum projects. Another option could be to leverage the products and services created as part of the DeFi movement to fund public goods, just as the recently announced R-Trees is doing. The idea here would be to lock stablecoins in interest-generating smart contracts and while everyone maintains ownership and access of the underlying stablecoins at all times, all of the interest will be siphoned off and used to fund some given project. If necessary, this idea could be combined with a lock drop, which increasingly rewards users with new tokens the longer they keep their money locked up. Alternatively, it might be better to integrate developer funding as a core aspect of the underlying blockchains. A clunky and fairly primitive version of this idea already exists in the form of block reward funding, but things like Near Protocol might be doing it better by simply redirecting a sliver of a given transaction's fees back to the developers of the smart contracts that were called in that transaction. In the coming years, these kinds of innovative and novel funding approaches will mature and be joined by even newer, even more experimental ideas that will compete with the pre-existing funding mechanisms, and ultimately move us closer to finding the optimum business model for decentralized open source projects. A transition away from ICOs in favour of better, more sustainable, and ultimately more wholesome funding mechanisms is just one way that crypto assets could improve and mature in the years to come. But we all know that there are many other aspects of this industry that could do with some improvements. Exchanges are an obvious one. For years, people have warned about all kinds of unscrupulous and irresponsible behaviours from crypto asset exchanges, but for the most part, these concerns have been lost in the noise or fallen on deaf ears. Occasionally, though, something breaks through and draws everybody's attention to some of these problems. Last year, for example, the Bitwise report focused minds on the issues of fake trading volume, while the Quadriga fiasco served as a reminder of a whole host of exchange-related problems. Still, though, numerous exchanges report fake trade volumes, numerous exchanges have questionable listing policies, numerous exchanges have poor security practices, or refuse to provide proof of reserves, or allow their customers to leverage their trades to a ludicrous level and don't give any warning of the dangers of this. Another area in desperate need of improvement are coin ranking sites like CoinMarketCap, sites that proliferate and support the lies of exchanges, that take the trading volumes at face value so that even the most obscure trade venues can rank higher than Coinbase or Binance. In fact, they even incentivize the falsification of volume data through poorly thought out exchange and asset listing policies. And worse, they continually shepherd users towards any dubious and sketchy exchange that offers them a referral link. And they further their revenues by hosting the adverts of anybody who comes calling, something that caused a lot of controversy back in the days of BitConnect. Thankfully, progress is already here in the form of vastly superior alternatives like Nomics and Messari's on-chain FX, and hopefully as the years pass by, subpar websites like CoinMarketCap will either shape up or be replaced by the alternatives. Messari also offers a disclosures registry, which intends to be a central repository for detailed information and disclosures about every crypto asset, something that could help to reduce the fraud, exploitation, and other unethical behaviours that have tarnished this industry's reputation. I really hope this, or something just like it, can catch on in the next few years, and I think that its level of success could be viewed as a kind of barometer for the moral health of this industry. And there are numerous other things I could talk about here, such as content creators who fail to disclose sponsorships, or usher their users towards incredibly risky leveraged trading products. I could talk about project teams that realise they won't meet their goals and simply walk away with investors' money instead of redistributing it like DigixDAO did. Or the fact that no one ever wants to take responsibility or accept criticism, dismissing anything that's remotely negative as baseless FUD rather than actually fixing anything. If all of these things are allowed to persist, if we don't see any efforts to improve on them, then I'm not sure that crypto assets can ever really be considered successful, no matter how many people actually start using them. It wouldn't be unfair to say that some crypto OGs can sound paranoid at times, always on edge about some upcoming government-level attack on Bitcoin. But the thing is, they're probably right to be worried, at least a bit. After all, we've already seen several countries unsuccessfully attempt to ban Bitcoin, so it's not much of a stretch to think their efforts could be ramped up in the years to come as Bitcoin becomes a greater menace to them. Of course, it's also true that many countries haven't taken an anti-Bitcoin stance. Perhaps they've introduced some poorly thought out regulation, and they probably have a harmful attitude towards privacy and want to force KYC on everyone, but at least they're happy for people to access and use Bitcoin easily. So maybe we are all good, maybe nobody needs to worry. But I don't think so, not yet at least. Bitcoin has benefited from its complexity and relatively small scale so far. But it seems likely that criticism and scrutiny will intensify as it becomes better known and better understood. Add a catalyst or two into that situation, and new regulations that outlaw or heavily restrict the usage of Bitcoin become a realistic possibility. But what could those catalysts be? An obvious possibility is an uptick in criminal behaviour and terrorist funding. It's almost certain that the dollar remains the dominant form of criminal money for the foreseeable future, but that fact won't really matter much if the narrative becomes Bitcoin just enabled a terrorist attack. Another candidate is Bitcoin's extreme energy usage, which obviously looks terrible to the masses that are finally starting to take climate change seriously. Some Bitcoiners have tried to get ahead of this criticism by claiming that mining is somehow beneficial for the environment and that it incentivizes renewables. But these arguments are both deeply flawed and unlikely to win over people when the counter-argument is Bitcoin uses more energy than Belgium. Bitcoiners will have to hope that the focus of the climate movement is on energy generation instead of energy usage, but even then a backlash against Bitcoin would be understandable. One alternative, more insidious, and I think more likely possibility is that a full-on regulatory crackdown never actually comes, because it won't need to. Instead, a steady trickle of regulations aimed at custodians and exchanges will effectively smother all of Bitcoin's undesirable and dangerous features. Not exactly killing it, but just transforming it into another payment network. Bitcoin would remain legal and usable for the majority of people, and it would probably still satisfy the number go up crowd, but it would no longer provide the benefits to any of the people who actually need it. The open finance or DeFi movement comes into the 2020s with a lot of momentum behind it. More than $1 billion of value is now locked in DeFi products, a psychologically significant but slightly misleading milestone, and it's undeniably among the most interesting segments of this industry right now. But there are big questions around it. Can it sustain its growth and momentum? Can it find purpose beyond assisting speculation? Will there be a DAO moment where a catastrophic failure causes the entire thing to implode? And if so, how long will it take for people to start picking up the pieces and trying again? It's quite possible that this industry's first breakout success comes from a DeFi app, with something like Pool Together standing as the most likely option right now. But it's also possible, and perhaps even more likely, that DeFi will collapse like a house of cards. One of the defining features of open finance is composability, with DeFi supporters describing the assortment of component apps as money Lego that can be connected and combined in any way by anyone. That opens the door to an unprecedented level of innovation and experimentation, but it also creates massive systemic risk. A bug or an attack on one component, even a relatively small one, could have cascading consequences that results in millions of dollars worth of damage. However, I'm hopeful that a solution can be found to mitigate that risk. Improvements in key technologies like oracles will help, as will the emergence of various standards and best practices around testing, implementing, and interconnecting different components. These things will naturally happen with time, but there are other, larger changes that could be made in the meantime. Reducing the total reliance on DAI by diversifying DeFi across multiple decentralized stablecoins would be a good start. The recent announcement of Metacoin, a governance-minimizing stablecoin that was created to address many of MakerDAO's major flaws, is certainly a step in the right direction. If we could add in a couple more alternatives, especially ones using entirely different designs such as Ampleforth, then the likelihood of a total system collapse should fall considerably. At the same time, trust-minimized insurance products could be created to give DeFi users greater confidence in their money's safety. There are already a number of projects exploring this opportunity, such as Nexus Mutual with DAO-issued insurance, and Open, who have created an options-based insurance product, and I'm sure other alternatives will come to market in the coming years. While these are unlikely to replicate the assurance of FDIC or FSCS backing in the traditional world, they could do a lot to make DeFi feel safer for everyday people. And they'll have the great side effect of the insurers being heavily incentivized to perform rigorous security audits and tests on any smart contracts that they choose to insure, adding another layer of protection to the entire ecosystem. Whether these kinds of changes would stabilise open finance and help it to take off, or would just be paper over some very deep cracks, remains to be seen. But with the recent BZX attacks potentially indicating open season on DeFi protocols, there may not be much time to find out. If you're anything like me and you spend almost all of your time trying to keep up with the latest events and developments in this industry, it's easy to think that crypto assets are far more popular, important, and influential than they actually are. Even Bitcoin, by far the most established and best recognized crypto asset, exists at the very fringe of pop culture. And most people probably haven't even thought about it since some family member kept trying to make them buy it back in 2017. But will this situation begin to change in the 2020s? Will there be anything that finds traction and breaks into the mainstream? Potentially. Bitcoin is the obvious place to look for the first success, not only because it's already quite established and in the process of financialization, but because the global environment is rapidly developing a set of characteristics that makes Bitcoin incredibly relevant. This decade is likely to bring most people the triple whammy of negative interest rates, an economic downturn, and centrally issued digital currencies that could each, in their own way, push people in Bitcoin's direction. The Lightning Network could make Bitcoin doubly relevant, potentially allowing Bitcoin to fulfill its role as the internet's native currency, and enabling websites to begin replacing subscriptions and adverts with micropayments, though it's unclear if everyday people would actually prefer that setup. At the same time, Sats-backed services like Fold and Lolly could help onboard users. I don't think they'll necessarily create new Bitcoiners, but if Bitcoin is already becoming more mainstream, they'll provide an additional, super convenient way for people to accumulate and better understand Bitcoin. And what about altcoins? Will something other than Bitcoin finally find an audience and a definitive purpose in the 2020s? Open finance is a possibility, as we've already discussed, but so are NFTs and crypto gaming, areas that saw decent growth in 2019 and connect to very forward-thinking industries. Perhaps gambling could be thrown in with them as well, but this isn't an area I particularly pay attention to or know anything about, so I don't want to make any strong comments on that. Another interesting possibility for growth, one that has generated headlines recently, is celebrity and self-tokenization, particularly in the form of income-sharing agreements or ISAs. These could provide people with new ways to monetize their time and skills, and while it's early days for these, it is a good idea, and the fact that there is already a fairly high-profile example of them in the wild is encouraging. For the most part though, I think we're going to see another decade of building. Base layer infrastructure is still being planned and created. It'll be difficult for anything to gain traction until those sorts of things stabilize. And many of the lower and middle layer components of what could one day become the Web3 stack, things like Orchid, Golem, LivePeer, and Sire, are still in embryonic phases, requiring a lot of refinement before they can be integrated into larger and easier to use apps so that normal people can actually benefit from them. Even things that have shown signs of growth and minor usage in the last couple of years, things like DAOs, are highly experimental and nowhere near ready for prime time. So I don't expect to see much adoption until well into the next decade, and that could be disheartening for some, especially as many of the efforts that do exist now may well fail or fold due to lack of funds in the future. Perhaps that's an overly pessimistic outlook. After all, things can change very rapidly, especially in areas of free and open innovation, and a decade is a long time. But we will find out, and I would love to be proved wrong about the pace of these developments. Bitcoin could be held responsible for all sorts of things, but arguably its most significant impact has been in promoting conversations about and changing the way people think about money. Here, when I say money, I mean the very concept of it. Bitcoin has made people reconsider what money is and what it can be, what attributes a good money should have, and who, if anyone, should control it. Thanks to Bitcoin, the Overton window for money has expanded to the point where private companies like Facebook can consider launching their own currencies, meaning we're likely to see a trifurcation of money in the coming years. First, we'll have semi-traditional government-issued currencies. I say semi-traditional here, as many countries will soon follow the lead of Sweden and China in launching central bank digital currencies or CBDCs, essentially natively digital versions of their existing currency. Then there will be privately issued corporate currencies like Libra. These may be pegged to one or more existing currencies, as Libra intends to do, or they could be free floating. And finally, there will be essentially publicly owned cryptocurrencies like Bitcoin, which are issued and controlled by absolutely nobody and whose value floats freely against all other currencies. Out of all three, only one, cryptocurrencies, will provide a truly cash-like experience, free from censorship, confiscation, debasement, and surveillance. At the same time, the alternative kinds of money will likely be far easier to use from the off. They'll be more scalable and they'll have name recognition that might make them more trustable to the normal person. In short, both CBDCs and corporate coins could provide some real competition to Bitcoin and other cryptocurrencies, delivering what's necessary to attract the masses, but not the all-important features that makes Bitcoin so special. A combination that could one day put a lot of people in a lot of danger. Alternatively, things like Libra could be a stepping stone into Bitcoin, getting people acquainted with the idea of holding and using digital currencies, and then, assuming Bitcoin continues to be an attractive investment moving forwards, there'll be far fewer concerns that hold people back from buying into it. Eventually, some might argue, Bitcoin would steal market share back from the other digital currencies simply because it will hold value better than anything else. Perhaps that's a stretch, but there is a fairly compelling argument in there somewhere. Really, though, it's unclear what sort of impact CBDCs and corporate coins will have on Bitcoin or the world at large. It's unclear if they'll see decent uptake, or what form they'll arrive in, or what stipulations regulators will force on privately issued monies. It's unclear even if we'll see many centrally issued digital currencies emerge this decade, or if the glacial pace of government developments and swathes of red tape imposed on private companies will hold back much of the innovation. Whatever happens, it's clear that the starting gun has been fired in this race to define the future of money. And that, while it's easy to see these things going in a rather dystopian direction, it will be a fascinating thing to watch unfold. So that's the list for now. There's obviously so many other things I could have included on here, but if I allowed myself to keep going, we would probably be well into the 2030s by the time I finished, so I have to limit myself. One thing that is certain though is that the 2020s should be another massively exciting decade for crypto assets, one that is likely to produce almost as many new questions as it answers. Whatever happens, I intend to be here as often as I can throughout the years, looking at and talking about the latest developments and everything going on around this space. At some point fairly soon, hopefully in the next month or so, I'll do another video talking about what my intentions are with this channel moving forwards, and about what and why I want to change things up a bit, and why I've taken down a lot of my older videos. I'll also be working hard, of course, on more normal content, so that will come out as soon as I can finish it as well. Until then, have a great day, and thank you very much for watching.